It began not with a bang, but with a whisper, a subtle change in the economic air that most people, even seasoned investors, failed to notice. It was a warmth that felt good at first, like the early days of spring. The market was rising, corporate earnings were reported in ever larger numbers, and the headlines screamed of new highs. But underneath this pleasant warmth, a fever was taking hold. A silent, invisible parasite had entered the bloodstream of the economy, an organism that thrives on the very growth it seems to promote, while secretly hollowing out its host from the inside. Warren Buffett, in his characteristically blunt and folksy way, gave this parasite a name. He called it the tapeworm. Inflation, he wrote, is a gigantic corporate tapeworm. It preemptively consumes its host's sustenance, leaving it weak and anemic, even as it appears to be growing larger on the outside. This tapeworm consumes real assets, real purchasing power, and the real futures of those who don't understand how it operates. For the average investor, the one whose personal finance tips come from cable news and online forums, this concept is entirely alien. They see a stock price go from $100 to $110, and they celebrate a 10% gain. They see a company's revenues climb by 15%, and they cheer for its growth. They are, however, victims of a profound cognitive bias, a flaw in human wiring that makes us all susceptible to the tapeworm's greatest trick, the money illusion. This is the story of that tapeworm, the story of how to diagnose it, how to avoid the businesses it infects, and most importantly, how to find the rare, magnificent creatures that are immune to its bite, the businesses that actually grow stronger as the parasite spreads. This is the blueprint for building an inflation-proof portfolio, a fortress of capital preservation designed not just to survive the coming economic fever, but to thrive in it. This is the financial education you were never offered, the key to unlocking true, lasting financial freedom in a world where the very definition of a dollar is constantly under attack. Our journey into this critical aspect of wealth management begins in a time that mirrors our own in unsettling ways, the late 1970s. The United States was in the grip of what was then called the Great Inflation. It was a period of profound economic malaise, a suffocating combination of stagnant growth and soaring prices known as stagflation. The misery index, a simple sum of the inflation and unemployment rates, was at an all-time high. Confidence in the government, in the economy, and in the future was at an all-trough low. For investors, it was a bewildering and terrifying time. The old rules no longer seemed to apply. For decades, the conventional wisdom had been that stocks were a great hedge against inflation. The logic was simple. A stock represents ownership in a real business, with real assets like factories and machinery. As the value of the dollar declined, the nominal value of those assets and the products they produced should rise in lockstep, protecting the shareholders' purchasing power. But it wasn't happening. From 1966 to 1981, the Dow Jones Industrial Average went precisely nowhere. It was a brutal, 15-year stretch of zero nominal gains. But when you factor in the corrosive effects of inflation, the real purchasing power return for investors over that decade and a half was a staggering negative 75%. People who had diligently saved and invested for their retirement, following all the standard personal finance tips, saw the value of their life's work decimated. It was in this environment of confusion and despair that Warren Buffett took to his typewriter. From his modest office in Omaha, Nebraska, he began writing a series of essays, published in Fortune magazine and his own Berkshire Hathaway annual letters, that would serve as a lighthouse in the storm. He wasn't just offering stock-picking advice, he was providing a desperately needed economic analysis of what was truly happening beneath the surface. In his 1977 essay, How Inflation Swindles the Equity Investor, Buffett laid out the tapeworm thesis with devastating clarity. He explained that a business is not just a collection of assets that can be repriced. It is an economic engine that produces a return on the capital invested in it. Think of a business, he urged, as a bond that pays a coupon. If you invest $1 million of capital into a business, what he called the equity coupon, and it earns a 12% return, it generates $120,000 in profit. In a world with no inflation, this is a wonderful outcome. But now, introduce the tapeworm. Let's say inflation is running at 8%. That $1 million capital base, the factories and machines and inventory, now costs $1,080,000 to replace at the end of the year. The business must retain $80,000 of its profit just to stand still, just to maintain its same level of physical output. That $80,000 isn't growth. It's a hidden maintenance cost imposed by inflation. It's the tapeworm taking its share off the top. So the real profit available to the owners is only $40,000. The real return on that $1 million investment has plummeted from 12% to just 4%. And then, the government steps in and delivers the final, brutal blow. The taxman doesn't see the $80,000 as a maintenance cost. He sees the full $120,000 as profit and taxes it accordingly. Assuming a 50% corporate tax rate, the company pays $60,000 in taxes. So now, from the $120,000 profit, $80,000 is consumed by the tapeworm of inflation, and $60,000 is consumed by taxes. The business has paid out $140,000 from a $120,000 profit. It has suffered a real after-tax loss of $20,000, all while reporting a handsome pre-tax profit. This, Buffett explained, was the swindle. The stock market, which was supposed to be a haven, had become a trap, invisibly confiscating wealth on a massive scale. The psychological principle at the heart of this great swindle is one of the most pervasive and dangerous cognitive biases affecting every retail investor and even seasoned professionals: the money illusion. Our brains are not naturally wired to think in real inflation-adjusted terms. We are wired to think in nominal terms. A bigger number feels better than a smaller number. It's a simple, primal heuristic that served our ancestors well but is disastrous in modern finance. When your boss gives you a 5% raise, you feel good. You have more dollars in your paycheck. But if inflation is running at 7%, you have actually taken a 2% pay cut in terms of what your money can actually buy. Your purchasing power has declined, yet you feel richer. This is the money illusion. It's the same illusion that convinces people their house is a great investment because they bought it for $200,000 and sold it for $300,000 10 years later, ignoring the fact that inflation during that period might mean their real gain was close to zero, before even considering taxes, maintenance, and transaction costs. In the stock market, this illusion is amplified. The daily fluctuations, the green and red numbers flashing on the screen, are all nominal. The entire financial media complex reports on nominal milestones. The Dow crosses 40,000. This obsession with nominal figures creates a dangerous feedback loop. Investors chase stocks that are going up in price, celebrating their nominal gains, without ever stopping to perform the simple but crucial calculation of their real return. They are like a hamster running on a wheel, expending enormous energy but making no real forward progress, all while the tapeworm quietly consumes their future. So how can an investor, intent on building wealth and achieving financial freedom, break free from this illusion? The first step is to adopt a new mental model, a new lens through which to view every single investment. It's called the Real Return Blueprint, and it's a simple but profoundly powerful calculation that you must burn into your brain. It is the antidote to the money illusion. The formula has 3 simple steps. First, calculate your nominal return. If you buy a stock at 100 and sell it at 120, your nominal return is 20%. Second, subtract the rate of inflation during the period you held the investment. If inflation was 5%, your pre-tax real return is 20% minus 5%, which equals 15%. Third, and this is the step almost everyone forgets, you must account for taxes on the time nominal time gain. Your $20 gain is taxed. If your capital gains tax rate is 20%, you owe $4 in tax. This $4 of tax on a real gain of $15 is an effective tax rate of over 26% on your real profit. Your final after-tax, after-inflation real return is not 20%, but just 11%. Let's run a more realistic and more sobering example from an inflationary environment. You buy a stock for $100. A year later, it's at $108. You feel pretty good about your 8% return, which is close to the long-term stock market average. But inflation that year was 10%. Your pre-tax real return is 8% minus 10%, which is negative 2%. You have already lost purchasing power. But you still have to pay taxes on your gain of $8. At a 20% tax rate, that's $1.60. So you lost $2 in purchasing power, and then paid another $1.60 in taxes. Your total real loss is $3.60, or negative 3.6%. You saw your account statement go up, you paid taxes as if you made a profit, but in reality, you became poorer. This simple blueprint, this mental model of always calculating the after-tax real return, is the first and most critical piece of armor in your inflation-proof portfolio. It forces you to see past the illusion and confront the cold, hard reality of what your money is actually doing. The path of the 99% is to completely ignore this reality. The average investor and even many financial advisors remain blissfully trapped in the world of nominal returns. Their entire framework for success is built on a foundation of sand. They chase performance, buying last year's winners. They look at a chart and see a line going up and to the right, and they feel the siren's call of easy money. They don't perform the rigorous economic analysis required to understand the underlying business. They don't read the annual reports. They don't calculate the real return. They operate on tips, hunches, and headlines. During the great inflation of the 70s, this path led to ruin. People who saw the value of their cash being eroded by inflation did what they thought was the smart thing. They moved their money into stocks and bonds. They bought shares in the great American industrial companies, the bedrock of the economy. They bought bonds issued by those same companies, believing they were getting a safe, reliable yield. But they failed to understand the tapeworm. They were buying into businesses whose reported profits were a mirage, businesses that were slowly being liquidated by the combined forces of inflation and taxation. Their quest for building wealth became an accelerated path to its destruction. The antithesis of the Buffett approach is not just picking the wrong stocks, it's using the wrong map of the world. It is a fundamental misunderstanding of the battlefield. The 99% think the game is about picking stocks that go up. The 1%, the masters of capital preservation, know the game is about finding businesses whose intrinsic value increases at a rate faster than the currency is debased. It is a completely different sport. The direct financial connection of this insidious tapeworm is most clearly visible on the balance sheet and in the valuation of a company. Inflation is a tax on capital. And for a business, its balance sheet represents its capital. Consider a company with $1 billion in assets. If inflation is 10%, that company will need to spend $100 million that year just to end the year with the same productive capacity it started with. That $100 million is a real expense that doesn't show up on the income statement as a formal line item. It's hidden within depreciation that no longer reflects reality. Depreciation is based on historical cost, the original price of an asset. But in an inflationary world, the replacement cost of that asset is vastly higher. A machine bought for $1 million 10 years ago might cost $3 million to replace today. The depreciation schedule, however, is still based on the $1 million figure, which means reported profits are artificially and dangerously inflated. This creates what Buffett called phantom profits. This has a devastating effect on a company's stock price. The value of any asset is the present value of its future cash flows. When inflation is high, two things happen. First, as we've seen, the real future cash flows are lower than they appear, because more cash has to be retained to fight the tapeworm. Second, the discount rate used to bring those future cash flows back to the present value goes up, as interest rates rise to fight inflation. So you have a smaller numerator, real cash flows, being divided by a larger denominator, discount rate. The result is a mathematical certainty. The present value, the stock price, must fall. This is why the stock market went nowhere in the 70s. It wasn't because American business suddenly became terrible. It was because the fundamental mathematics of valuation had been poisoned by the inflationary tapeworm, and only a few, like Buffett, understood the true nature of the disease. The first place this disease metastasizes is within a specific type of business, the kind that the 99% of investors flock to during uncertain times, believing them to be safe. These are the companies with huge capital needs, the industrial giants, the utilities, the airlines, the manufacturers. They are the companies that own the real assets that are supposed to be a hedge against inflation. But this is a tragic and costly mistake. They are not a hedge, they are a trap. There is no better illustration of this principle than Warren Buffett's own painful, first-hand experience with the original business that gave his holding company its name, Berkshire Hathaway, the textile manufacturer. When Buffett took control of Berkshire in 1965, it was a struggling New England textile mill. For the next 20 years, he and his partner, Charlie Munger, fought a brutal, grinding battle against what they termed the textile industry's hopeless economics. The core of the problem was capital intensity. A textile mill is a symphony of machinery, looms, spindles, finishers. This equipment is expensive, it wears out, and it is subject to constant technological improvement. To stay competitive, you had to constantly pour money back into the business, buying newer, faster, more efficient looms. Buffett described it as running on a treadmill. Every dollar of profit the business managed to eke out had to be immediately reinvested into new machinery just to keep up with the competition. In a normal environment, this is a tough business. In an inflationary environment, it becomes a death sentence. Let's put some real numbers to this foundational anecdote. In the 10 years from 1955 to 1964, just before Buffett took control, the entire New England textile industry had earned, in aggregate, next to nothing. It had spent hundreds of millions of dollars on new plants and equipment, yet the aggregate return on equity was pathetic. When Buffett arrived, he tried to be smarter. He focused on niche products and efficient operations, but he couldn't escape the fundamental physics of the industry. In 1979, at the height of the Great Inflation, he wrote about this pain in his annual letter. He explained that a new loom that cost $50,000 a decade earlier now cost $300,000. The cost had sextupled, but the amount of cloth that the new loom could produce hadn't sextupled. The profit margins on that cloth hadn't sextupled. The company had to spend vastly more capital just to get a modest increase in output. All the retained earnings were being consumed by the rising replacement cost of the machinery. It was the tapeworm in its most virulent form. The business was spending more and more just to stay in the same place. Finally, in 1985, after 2 decades of fighting, Buffett mercifully shut the textile operations down. It was a failure, but it was perhaps the most valuable failure in business history, for it taught him the single most important lesson of his career: the sheer futility of putting capital into a business that is forced to run faster and faster simply to stand still. He learned that during periods of inflation, the worst possible business to own is one that requires continuous, massive capital investment. The underlying psychological principle that keeps investors and corporate managers alike trapped in these capital-intensive nightmares is a powerful combination of the sunk cost fallacy and its evil twin, escalation of commitment. The sunk cost fallacy is our irrational tendency to continue with an endeavor because we have already invested time, money, or effort into it, even if the current evidence suggests we should stop. A manager who has spent 5 years and $1 billion building a new factory is psychologically incapable of admitting it was a mistake, even when faced with overwhelming evidence that the factory will never earn a decent return. The $1 billion is sunk, it's gone, and all that matters are the future prospects. But our brains don't work that way. To abandon the project is to admit a massive public failure. So instead, they escalate their commitment. We just need to invest another $200 million in upgrades, they'll argue, and then it will turn the corner. This is pouring good money after bad, a desperate attempt to justify the initial decision. Inflation acts as a powerful accelerant to this psychological flaw. As the cost to complete the project or replace the equipment skyrockets, the commitment becomes even more intense. The numbers get bigger, the stakes get higher, and the psychological pressure to see it through becomes unbearable. Investors fall for the same trap. They buy a stock in an airline because they see the impressive, tangible assets, the multi-million-dollar planes. When the stock performs poorly because the airline has to constantly spend billions on new, more fuel-efficient planes just to compete, the investor doesn't sell. Instead, they think, "I've already lost so much, I have to hold on until it comes back." They anchor to their original purchase price and escalate their commitment to a failing investment, all while the capital-intensive nature of the business ensures its continuous destruction of shareholder value. To protect yourself from this trap, you need an applied mental model, a tool to screen companies, and immediately identify the ones caught on this treadmill of futility. The most effective tool is what we'll call the CapEx to depreciation ratio. It is a simple but brilliantly insightful diagnostic test that you can perform on any company with just a few minutes and its cash flow statement. Here is your blueprint. First, pull up the company's most recent annual report, or 10K filing. Go to the Consolidated Statement of Cash Flows. You are looking for two specific line items under Cash Flow from Investing Activities and Cash Flow from Operating Activities. The first is capital expenditures, or purchases of property, plant, and equipment. This number represents how much cash the company actually spent in a given year on new machinery, buildings, and other fixed assets. The second number, usually found near the top of the cash flow statement, is depreciation and amortization. This is a non-cash accounting charge that represents the supposed using up of the company's existing assets. Now for the crucial step. Divide the capital expenditures, CapEx, by the depreciation. If a company is in a stable state, not growing aggressively, and not in an inflationary environment, this ratio should be around 1. This would mean it's spending about the same amount on new assets as its old assets are depreciating. This is a business that is effectively standing still. However, if this ratio is consistently and significantly greater than 1, say 1.5 or 2 or even higher, it is a massive red flag. It means the company has to spend far more than its depreciation charge just to maintain its current competitive position. During inflation, this ratio explodes for capital-intensive businesses. The depreciation charge is based on old, historical costs, while the CapEx is based on new, inflated costs. A ratio of 2 or 3 becomes common, revealing a business that is gushing cash just to replace its asset base. This is the financial signature of the futile motion Buffett experienced with his textile mills. It is a quantitative measure of a company running on a treadmill, a clear signal for you, the intelligent investor, to stay far away. The antithesis of this careful analysis, the path of the 99%, is to actively seek out these capital-intensive businesses during inflation. The flawed logic is seductive and widespread. The advice you'll hear is to buy real assets. People think that in a time when paper money is losing value, you should own things you can touch: land, buildings, factories, railroads, oil reserves. It seems intuitive. These are tangible things, and their nominal dollar value should increase as the value of the dollar decreases. But this completely misses the central point of the tapeworm thesis. A factory is not an inert store of value like a bar of gold. A factory is an active piece of a business that consumes capital. It needs maintenance. It needs to be replaced. And as we've seen, its replacement cost skyrockets during inflation, consuming all the supposed profits. Owning a railroad is not like owning a painting. A painting doesn't require billions of dollars in new track and locomotives every few years. Owning an airline is not like owning a rare diamond. A diamond doesn't have engines that need to be overhauled at a cost of millions of inflated dollars. The 99% chase the illusion of safety in tangible assets, confusing the asset itself with a good investment. They fail to ask the crucial question: what is the return on the capital required to maintain that asset? For most capital-intensive businesses during inflation, that return is miserable or even negative. They are not buying a hedge against inflation. They are buying the tapeworm's favorite meal. The direct financial connection of this capital-intensive trap is a phenomenon known as return on invested capital, or ROIC compression. ROIC is one of the most important metrics for evaluating the quality of a business. It measures how much profit a company generates for every dollar of capital that has been invested in it. The formula is simple: net operating profit after tax, NOPAT, divided by invested capital. A great business can consistently generate a high ROIC, say 20% or more. A poor business struggles to earn a return greater than its cost of capital. Inflation wages a two-front war on the ROIC of a capital-intensive business. First, it attacks the denominator, the invested capital. As the company is forced to replace its plant and equipment at ever higher prices, the amount of capital on its balance sheet balloons. A factory that was on the books for $100 million is replaced by a new one that costs $300 million. The invested capital triples. Now, for the ROIC to stay the same, the numerator, the profit, would also have to triple. But does it? Rarely. The company might be able to raise prices a bit, but often not enough to keep pace with the massive inflation in its capital base, especially if it's in a competitive industry. The result is that the numerator grows slowly while the denominator explodes. The ROIC gets compressed, squeezed from both sides. A business that used to earn a respectable 15% ROIC might see that fall to 5% during a period of high inflation. At that point, it is no longer creating value for its shareholders. It has become a destroyer of capital. This ROIC compression is the mathematical embodiment of running on a treadmill. It is the clearest possible financial evidence that a business is caught in the capital-intensive trap. A trap that the intelligent investor armed with this knowledge can now easily avoid. If the capital-intensive business is the tapeworm's ideal host, then what is its natural predator? What kind of business is immune to this destructive parasite? The answer lies in the first of two critical traits that define an inflation-proof enterprise: pricing power. Pricing power is a company's ability to raise its prices to cover rising costs and even increase its profit margins without losing a significant number of customers to its competitors. It is, as Buffett has stated, the single most important decision in evaluating a business. A company with strong pricing power can simply pass the effects of inflation onto its customers, protecting its own profitability. A company without it is forced to absorb those rising costs, watching its margins get crushed until it eventually becomes unprofitable. There is no better case study in the history of business for the power of this principle than another of Buffett's most famous investments, See's Candies. Berkshire Hathaway purchased See's in 1972 for $25 million. At the time, See's was selling about 16 million pounds of candy a year at a price of $1.95 per pound and earning about $2 million after tax. It was a good, solid, but seemingly unremarkable business. What Buffett saw, however, was not just a candy company. He saw a business with a near-magical economic characteristic. The foundational anecdote of See's Candies is a masterclass in pricing power. See's had built a fanatically loyal customer base in California over decades. The brand was synonymous with quality, nostalgia, and special occasions. When a customer bought a box of See's, they weren't just buying chocolate. They were buying a feeling, a tradition, a guaranteed positive social transaction. This powerful emotional connection gave See's an extraordinary degree of pricing power. Each year, as the costs of sugar, cocoa, labor, and boxes went up due to inflation, the managers of See's, Charles and Brad Huggins, would sit down and calculate the new price for a pound of candy. They would raise it enough to cover their cost increases, and then they'd add a little more on top for good measure. And what happened? Nothing. The customers grumbled for a moment, and then they paid the new price. They weren't going to risk disappointing their mother on her birthday by showing up with a generic, inferior box of chocolates. The gift-giving impulse, the emotional weight of the purchase, completely overwhelmed the rational price-shopping instinct. Over the years, Buffett watched in delight as the price of a pound of See's candy went from under $2 to over $20. The volume of candy sold didn't grow much, it was a mature business, but the profits soared. By the 2000s, See's was generating over $80 million a year in pre-tax profit, and it had delivered over $2 billion in total earnings to Berkshire Hathaway, all from an initial investment of just $25 million. See's Candies became Buffett's prototype for the perfect business, one whose intangible asset, its brand, allowed it to effortlessly deflect the ravages of inflation. It was an economic toll booth. If you wanted to cross the bridge of a happy holiday or a special gift, you had to pay the See's toll, and the tollkeeper could raise the price every single year. The underlying psychological principle that creates this incredible business advantage is a concept from microeconomics called price inelasticity of demand. A product has inelastic demand when a change in its price has little to no effect on the quantity that people demand. A 10% increase in price might only lead to a 1% decrease in sales. This is the holy grail for a business. What creates this inelasticity? It's rarely the physical product itself. It's the psychological wrapper around the product. It's the brand loyalty, the habit, the perceived status, or the lack of viable substitutes. For See's, it was the decades of positive emotional reinforcement. For a company like Apple, it's the ecosystem, the design aesthetic, and the social status associated with the iPhone. An iPhone user is highly unlikely to switch to an Android phone over a $100 price increase. The switching costs, both tangible and psychological, are too high. For a company like Coca-Cola, it's over a century of advertising that has burned the brand into the global consciousness as the definition of refreshment. A person who wants a Coke is not looking for a generic cola-flavored sugar water. They are looking for that specific branded experience. This deep-seated brand loyalty acts as a protective moat around the business's profitability. When the cost of aluminum for cans goes up, Coca-Cola doesn't have to absorb it. It simply prints a new price list. The company's most valuable asset isn't its secret formula or its bottling plants. It's the real estate it occupies in the minds of billions of consumers. That mental real estate is impervious to inflation. So how can you, the investor engaged in serious stock analysis, identify this crucial trait of pricing power? You need an applied mental model, a simple thought experiment you can run on any potential investment. Let's call it the price increase test. It's a qualitative tool, but it's more powerful than 100 complex financial ratios. Here's the blueprint. First, identify the company's core product or service. Be specific, not software, but Microsoft Office Productivity Suite, not coffee, but a Starbucks venti latte. Second, imagine that tomorrow morning, the company announces a 10% price increase across the board, with no change in the product. The iPhone now costs 10% more. Your Netflix subscription is 10% more. The toll on the bridge you take to work is 10% more. Third, and this is the most important step, honestly and brutally ask yourself, what would happen? Would a significant portion of the company's customers defect to a competitor? Would they stop using the product altogether? Or would they complain, curse the company's greed, and then, ultimately, pay the higher price? Be a detective. Think about the psychology of the customer. Think about the available substitutes. If your immediate gut-level answer is that the customers would pay, then you have likely identified a business with strong pricing power. Apply this test to a major airline. If they raise their prices by 10%, customers will instantly flock to a competitor's website to find a cheaper flight. The airline has zero pricing power. Now apply it to your local electric utility. If they raise their prices, what are you going to do? Read by candlelight? The utility has a monopoly, the ultimate form of pricing power. This simple thought experiment is your divining rod for finding the economic toll booths that can thrive in any inflationary environment. The path of the 99% is to invest in the exact opposite of these businesses. They are drawn to the commodity business trap. A commodity business is one that sells a product or service that is virtually undifferentiated from its competitors. The only thing that matters to the customer is price. Think of businesses that produce basic steel, lumber, corn, or iron ore. Think of trucking companies or most retail banking services. In these industries, the producer is a price taker, not a price maker. They have no control over the price they can charge. They must accept whatever the market dictates. For a commodity business, inflation is a death sentence. Their costs, labor, fuel, raw materials are all going up, but they are powerless to pass these increases on to their customers. If they try to raise their price by even a fraction, their customers will immediately switch to a cheaper supplier. The result is a vicious margin squeeze. They are caught between a rock and a hard place. Rising costs on one side and an inability to raise prices on the other. Their profitability evaporates. Investors who buy into these companies during inflation are making a catastrophic error. They might see a company whose revenues are increasing in nominal terms as the price of the commodity it sells goes up, but they fail to see that its input costs are rising even faster. They are confusing activity with progress and revenue growth with value creation. The commodity business trap is one of the most common ways for retail investors to see their portfolios destroyed by inflation. It's the quintessential example of a business that is at the mercy of the tapeworm, with no defense mechanism whatsoever. The direct financial connection of pricing power is immediately and beautifully visible on a company's income statement. The key metric to watch is the gross profit margin. The gross margin is calculated by taking a company's revenue and subtracting the cost of goods sold, COGS, then dividing that number by the revenue. It represents how much profit the company makes on each dollar of sales before accounting for overhead and administrative expenses. A company without pricing power, a commodity business, will see its gross margin get crushed during inflation. Its COGS, the cost of its raw materials and direct labor, will increase due to inflation. But since it can't raise its prices, its revenue per unit stays flat. The mathematical result is that its gross margin percentage shrinks. It becomes less and less profitable with every sale it makes. Now, look at a company with strong pricing power, like See's Candies. Its COGS also goes up. Sugar and chocolate become more expensive. But because it has pricing power, it can increase its prices by an even greater percentage. For example, if its costs go up by 10%, it might raise its prices by 12%. The result is not just a stable gross margin, but an asterisk expanding time gross margin. The company is not just protecting its profitability from inflation. It is actually becoming more profitable per unit because of inflation. Inflation, for this rare type of business, acts as a tailwind. It provides the perfect cover story for raising prices more than is strictly necessary to cover costs, widening the moat around its castle. When you are doing your stock analysis, look at the history of a company's gross margins, especially during past periods of economic stress. If you see a consistent, stable, or even rising gross margin, you have found a powerful clue. You have found the financial fingerprint of pricing power, a key component of your inflation-proof fortress. We have now identified the two great enemies of the investor in an inflationary age: the capital-intensive business that is forced to run on a treadmill of futile investment, and the commodity business that is squeezed to death by its inability to raise prices. We have also identified the first great champion of capital preservation, the business with pricing power, the economic toll booth that can pass inflation on to its customers. But there is a second, equally important characteristic that defines the ultimate inflation-proof company. It is the business that wins by needing almost nothing. This is the capital-light champion. A capital-light business is one that can grow its sales and profits without needing to make significant ongoing investments in property, plant, and equipment. Its primary assets are not physical, but intangible. Think of brands, patents, software code, or network effects. These assets don't wear out in the same way a machine does. They don't need to be replaced at ever-inflating prices. This immunity to capital decay makes them extraordinarily valuable, especially when the inflationary tapeworm is on the loose. The perfect foundational anecdote to illustrate this principle is the story of one of Buffett's greatest and most dramatic investments, American Express during the salad oil scandal. In 1963, a company called Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, went bankrupt. It was then discovered that the company had perpetrated a massive fraud. The giant tanks of salad oil that American Express had certified as collateral for loans were, in fact, mostly filled with seawater. When the fraud was revealed, Wall Street panicked. Investors feared that American Express would be on the hook for hundreds of millions of dollars in losses, potentially bankrupting the entire company. The stock price was annihilated, falling by over 50% in a matter of weeks. The consensus was that American Express was doomed. But Warren Buffett, then a young, relatively unknown money manager, did something different. He didn't just read the headlines, he did the work. He went out to restaurants and banks and travel agencies. He talked to customers and merchants. He wanted to understand the real business of American Express, separate from the warehousing division where the fraud had occurred. What he discovered was a business of breathtaking beauty. The core of American Express was its traveler's checks and its charge card. Think about the economics of the traveler's check business. Customers would give American Express their cash, and in return they would get a piece of paper that was accepted as money around the world. American Express could then hold on to that cash for weeks or months until the check was cashed, earning interest on this massive, interest-free loan from its customers, which was known as float. The charge card business was similar. It was a closed loop between wealthy cardholders and high-end merchants. The value wasn't in any physical asset. It was in the power of the network and the trust associated with the brand. Buffett realized that the salad oil scandal, while a painful and expensive one-time event, did not damage the core psychology of the brand. People were still using the cards. Merchants were still accepting them. He concluded that the fundamental business was not only intact, but was one of the best businesses in the world because it required virtually no capital to operate. It was a machine that gushed cash. He invested over 40% of his partnership's capital into the beaten-down stock and was rewarded with a multi-bagger return as the company recovered and the market realized the enduring power of its capital-light model. The underlying psychological principle that makes investors so consistently undervalue these capital-light champions is our innate bias towards the tangible. Our brains evolved over millions of years to interact with the physical world. We understand things we can see, touch, and weigh. A giant factory with smokestacks billowing smoke feels more real and more valuable than a piece of software code or a brand name that exists only in the collective consciousness of consumers. We can easily imagine the value of a fleet of airplanes, but we struggle to conceptualize the value of the network effect that makes Facebook or Google so dominant. This tangible bias causes a systematic mispricing in the market. Investors overvalue companies with impressive physical assets, especially during inflation when the replacement cost of those assets is climbing. And they undervalue companies whose assets are intangible, even though these are the very assets that are most resilient to inflation. An intangible asset like a brand doesn't rust. A patent doesn't need a new roof. A software platform doesn't require new machinery. They can often serve an infinite number of new customers with zero marginal cost. This shift from an economy based on atoms to one based on bits is one of the most powerful secular trends in modern history, and the investor who can overcome their tangible bias and appreciate the power of intangibles will have a profound and lasting advantage. This is a core component of advanced financial education, learning to see value where others only see air. To translate this appreciation for capital-light businesses into a rigorous, applied mental model for stock picking, we must once again turn to a tool that Buffett himself developed. He found that traditional accounting earnings, or net income, were a poor measure of a business's true economic reality, especially for capital-intensive businesses. So he created his own metric: owner earnings. Owner earnings provides a much clearer picture of the cash a business is truly generating for its owners. The blueprint for calculating it is as follows. Start with the company's reported net income. To this, add back any non-cash charges like depreciation and amortization. This gives you a rough proxy for the cash the business is generating from its operations. But now comes the crucial final step. You must subtract the average annual amount of capital expenditures the business needs to spend to maintain its long-term competitive position and its unit volume. This is the maintenance capex. This step is the key. By subtracting this real cash outlay, you are accounting for the cost of fighting the treadmill effect. For a capital-light business, like a software company or a brand powerhouse, this maintenance capex number is very small. As a result, its owner earnings are very close to its reported net income. But for a capital-intensive business, like an airline or a steel mill, this maintenance capex figure is enormous. Its owner earnings will be far, far lower than its reported net income. The difference is the amount of cash being consumed by the treadmill. By using owner earnings instead of net income as your primary valuation metric, you are forcing yourself to see the business as a true owner would, focusing on the real cash available for distribution or expansion, not on the phantom profits reported by accountants. This mental model is your X-ray vision for peering through misleading financial statements and identifying the true capital-light champions. The antithesis of this disciplined focus on owner earnings is the seductive but destructive path of empire building. This is the path of the 99% of corporate executives and the investors who cheer them on. The empire-building CEO is obsessed with growth for growth's sake. Their goal is not to maximize per-share value for the owners, but to maximize the size of the enterprise they command. They want the most revenue, the most employees, the most factories, the biggest global footprint. This desire is often driven by ego and by compensation structures that reward size over profitability. These CEOs embark on a relentless quest for expansion, making huge capital expenditures on flashy new headquarters, ill-advised acquisitions, and projects with dubious returns. The financial media loves these bold, visionary leaders. Investors get excited by the headlines of massive new investments and global expansion. But what they are actually witnessing is often the reckless destruction of capital. This empire-building tendency is dangerous in any environment, but it becomes catastrophic during inflation. The cost of building the empire skyrockets. The massive capital expenditures required to fund the growth are made with inflated dollars, ensuring that the company will have to earn vastly more profit just to break even on the investment. Investors who are drawn to these exciting growth stories are falling for a classic trap. They are mistaking the expansion of the empire for the creation of value. The disciplined investor, the one focused on owner earnings, understands that true value is created not by growing bigger, but by growing more profitable per unit of capital invested. They would rather own a small, capital-light business that gushes cash than a massive, capital-intensive empire that consumes it. The direct financial connection of a capital-light business model is found in the most important metric on the cash flow statement: free cash flow, or FCF. Free cash flow is the cash a company generates after subtracting the capital expenditures required to maintain or expand its asset base. It is the lifeblood of a business, the money that can be used to pay dividends, buy back stock, pay down debt, or make strategic acquisitions. It is, in essence, owner earnings in its purest form. A capital-light business is a free cash flow machine. Because its maintenance capex is so low, a very high percentage of its revenue and operating cash flow converts directly into free cash flow. As inflation pushes up its nominal revenues, especially if it also has pricing power, its free cash flow explodes upwards. A 10% increase in revenue might lead to a 20 or 30% increase in free cash flow because the capital expenditure base remains small and stable. This torrent of cash provides the ultimate protection and flexibility during economic turmoil. The company can reward shareholders, strengthen its balance sheet, and even acquire weaker, capital-intensive competitors who are struggling to survive. A key valuation metric that stems from this is the free cash flow yield, which is the free cash flow per share divided by the stock price. An investor in a capital-light champion is buying a claim on a powerful and rapidly growing stream of cash. An investor in a capital-intensive business is buying a claim on a business that is constantly forced to reinvest its cash just to avoid falling behind. In the long run, this difference in free cash flow generation is the single greatest determinant of long-term investment returns and the surest path to beating the S&P 500. We have now journeyed through the core principles of Buffett's framework for inflation-proof investing. We have unmasked the inflationary tapeworm and understood its devastating effect on most corporations. We have learned to identify and avoid the two types of businesses most susceptible to its ravages: the capital-intensive business running on a treadmill of futile investment, and the commodity business trapped by its lack of pricing power. And we have discovered the two essential traits of the businesses that are immune, the champions that thrive in inflationary times: the economic toll booth with the power to set its own prices, and the capital-light marvel that gushes cash without needing constant reinvestment. The final step is to synthesize these pillars into a coherent strategy for portfolio management. It is time to assemble the inflation-proof fortress. This is not about a single stock pick. It is about a philosophy of asset allocation and a mindset geared towards long-term capital preservation and the achievement of true financial freedom. The foundational anecdote for this synthesis is not a single transaction, but the broad pattern of Buffett's actions over decades, particularly during times of economic stress. Look at the core, long-term holdings of Berkshire Hathaway, especially those acquired during or after periods of economic turmoil. Think of the purchase of the Washington Post Company in the stagflationary 70s. Newspapers at the time were regional monopolies, the ultimate toll booth for local advertising, and they required very little capital to produce their daily product. Think of the massive investment in Coca-Cola in the late 1980s, after the market crash of 1987. Coca-Cola is the quintessential capital-light brand powerhouse with global pricing power. Think of the more recent, enormous stake in Apple. While Apple does sell physical products, its true value lies in its intangible assets: the brand, the iOS ecosystem, and the fanatical loyalty of its customers, which granted immense pricing power. Furthermore, compared to its gargantuan profits, its capital expenditure needs are relatively modest. Each of these investments, and many others like them, represents a deliberate decision to allocate capital to a business that fits the inflation-proof profile. Buffett wasn't just buying stocks. He was assembling a portfolio of economic fortresses, each with a deep, protective moat around it. This collection of businesses could withstand any economic storm, be it the deflationary panic of a market crash or the corrosive, grinding pressure of high inflation. This is the essence of strategic wealth management, not just picking winners, but constructing a portfolio whose collective characteristics make it resilient to the macroeconomic forces that destroy the wealth of the unprepared. The underlying psychological principle that governs this portfolio construction strategy is a powerful concept popularized by the author and risk analyst Nassim Nicholas Taleb, anti-fragility. Most investors think in terms of a simple dichotomy: fragile versus robust. A fragile object, like a glass vase, breaks under stress. A robust object, like a steel ingot, resists stress. But Taleb introduced a third category: the anti-fragile. An anti-fragile system is one that doesn't just resist shocks and volatility, it actually gets stronger from them. Think of the human immune system. When it is exposed to a pathogen, it is stressed, but it learns and adapts, emerging stronger and more capable of handling future attacks. An inflation-proof portfolio, constructed according to Buffett's principles, is designed to be anti-fragile to the shock of inflation. When inflation hits the economy, the weak, capital-intensive commodity businesses are wounded or killed off. They are the fragile players. The robust players might survive, but they don't necessarily benefit. But the anti-fragile companies, the ones with pricing power and capital-light models, actually see their competitive position improve. As their weaker rivals falter, they can gain market share. The cover of inflation allows them to expand their profit margins. The torrent of free cash they generate allows them to buy distressed assets at bargain prices. The shock of inflation, which is a crisis for most, becomes an opportunity for them. The goal of this advanced form of portfolio management is not to build a portfolio that can simply survive a storm, but to build one that can harness the storm's energy to sail faster and further than ever before. How can you, the retail investor or entrepreneur, apply this anti-fragile philosophy to your own capital allocation? You need a final, practical mental model, a systematic process for filtering your investment ideas. Let's call it the two-pillar portfolio savvy. This is your blueprint for building your own inflation-proof fortress, step by step. First, start with your universe of potential investments. This can be a list of companies you're familiar with, recommendations from a source you trust, or a broad market index. Second, you will pour this entire list into the first sieve, the pricing power test. For each company on your list, apply the price increase test thought experiment we developed earlier. If they announced a 10% price increase tomorrow, would their customers flee? If the answer is yes, the company fails the test. Discard it from your list immediately, no matter how cheap its stock seems or how much you like its story. It is fragile. Third, you will take the companies that survived the first sieve and pour them into the second one, the capital light test. For each remaining company, perform the capex to depreciation ratio analysis, or, for a more advanced look, calculate its owner earnings. If the company is a capital hog, consistently spending far more on capex than it reports in depreciation, it fails the test. Discard it. It may be robust, but it is caught on the treadmill. The companies that emerge from this two-stage filtering process, the ones that have passed through both sieves, are the elite. They are the capital-light toll booths. These are the anti-fragile champions that should form the core of your long-term, inflation-proof portfolio. This disciplined, systematic process removes emotion and hype from the equation and replaces it with a rigorous focus on the economic characteristics that truly matter for long-term capital preservation and growth. The path of the 99%, the antithesis of this focused approach, is the path of mindless diversification, or what Peter Lynch famously called diversification. The average investor is taught that diversification is the cardinal rule of safe investing. They are told to not put all their eggs in one basket, so they buy a little bit of everything. They buy mutual funds or ETFs that hold hundreds or even thousands of stocks, believing this broad ownership protects them from risk. In a stable, non-inflationary environment, this can be a reasonable, if uninspired, strategy. But during a period of high inflation, it is a recipe for guaranteed mediocrity, or worse. By buying the entire market, you are explicitly choosing to own all of the terrible, fragile, capital-intensive commodity businesses that are destined to be destroyed by the inflationary tapeworm. For every See's Candies or American Express you own a small piece of, you also own a piece of a struggling airline, a capital-guzzling steel mill, and a utility that is being crushed by rising costs. The terrible performance of these businesses will act as a powerful anchor, dragging down the returns of the few good businesses you happen to own. This is not intelligent risk management. It is simply diversifying away your potential for outperformance. The Buffett approach, filtered through the two-pillar sieve, advocates for the opposite: a concentrated portfolio of truly wonderful businesses. It is an acknowledgement that great, inflation-proof companies are rare, and that when you find one, you should invest with conviction. It is a strategy of putting many of your eggs in one basket and then watching that basket very, very carefully. The ultimate direct financial connection, The grand prize at the end of this intellectual journey is the long-term compounding of real purchasing power. This is the entire point of the exercise. The goal of investing is not to accumulate the most nominal dollars. The goal is to increase your ability to command real goods and services in the future. It is about achieving financial freedom in real terms. Imagine 3 portfolios over a 20-year period of persistent, challenging inflation. Portfolio A is built on the path of the 99%, filled with capital-intensive, commodity-type businesses. Its nominal value might bounce around, perhaps even ending the period slightly higher than where it started. But its real, inflation-adjusted value will have been utterly decimated. It will have lost the majority of its purchasing power. Portfolio B is the S&P 500 index fund, the path of diversification. It will perform better than Portfolio A, as its handful of great businesses will partially offset the drag from its many poor ones. It might manage to slightly outpace inflation, preserving the investor's capital but not significantly growing it. It is a path of survival, not triumph. And then there is Portfolio C, the inflation-proof fortress, a concentrated collection of capital-light toll booths assembled using the two-pillar sieve. This portfolio doesn't just survive inflation, it feasts on it. As its competitors weaken, its market position strengthens. As prices rise, its profit margins expand. As its free cash flow explodes, its value compounds at a rate far exceeding the erosion of the currency. At the end of the 20-year period, the chart would show a staggering divergence. The real, inflation-adjusted value of Portfolio C would be many multiples of where it began and leagues ahead of the other two. This is not a fantasy. This is the mathematical result of owning superior economic engines in an environment that punishes mediocrity. This is the financial transformation promised to those who do the work, who reject the conventional wisdom, and who learn to see the world through the clear, unflinching eyes of a true master of capital. You now possess the mental framework Warren Buffett uses to diagnose the corporate tapeworm of inflation. You understand why most businesses and most investors are destined to fail in its presence. You have the tools to identify the capital-intensive traps and the pricing power champions. You have acquired a powerful piece of the intellectual machinery required for true, long-term wealth creation. But identifying the right business is only the first half of the equation. The second, and perhaps more critical step, is understanding the two-way stacks price you should pay for it. A wonderful, inflation-proof business bought at a terrible speculative price can still be a catastrophic investment. Knowing Wonderforce to buy is useless without knowing when to buy it, and the video that is now appearing on your screen holds the key to that very discipline. It is the bridge between identifying a great company and buying it at a price that ensures your financial success. It is the other half of the map, the component that connects business analysis to valuation. For many, this is where the journey of financial education ends. The hard work of analysis is done, and it feels like enough. But for those who are truly committed to building a fortress of wealth, for those who see this not as a hobby but as the critical task of securing their family's future, the next step is not an option, it is a necessity. Complete your mental arsenal. Master the art of valuation. Click and continue your ascent.